Goodness, we're popular this afternoon. Blockchain is obviously a hot topic. So without further ado, I'll get the panel on stage. So first up, we have Anthony Woolley, who's the head of group innovation at Societe Generale, and I probably insulted everybody French by my pronunciation there. Then we have Hans Lombardo, who's the CMO from BlockPass. We have Marcus Treacher, the SVP of customer success at Ripple. And we have Peter Stevens, who's head of blockchain and UK group innovation at UBS. Please welcome my panel. Good afternoon, gents. So I'll start off by asking you each to do a quick introduction to yourselves, but you must do it in 2 sentences, because these good people want to hear more about blockchain. So 2 sentences each. Off you go, Anthony.
Okay, I'll work across the business functions in SG Group on disruptive things that are disrupting those business lines. A lot of that's connecting the outside world to SocGen, but also looking around the business cases driving that change.
Okay, my name is Hans Lombardo. I'm the CMO of BlockPass. I've been involved in investing in blockchain ecosystems since 2014. BlockPass is a blockchain-based identity verification management platform as a service that does things like KYC, know your customer, anti-money laundering verification.
I'm Marcus Treacher. I look after Ripple's customers worldwide.
Hi, my name is Pete Stevens. I lead UBS's research into blockchain DLT technology, based out of Level 39 in Canary Wharf. Prior to that, I was our regional CTO for Asia Pacific.
Brilliant. Well done, gents. Nice and short. So I have to remind you that you can send questions in. I'll be picking them up as we go through. So if anybody has any burning questions they want answered, do submit them through the app. They will be vetted out the back, so anything rude will be sliced out before I get it up here. So I'm just going to jump straight in with a yes or no question, and then hopefully we can come back at the end and we'll see if opinions have shifted. But is there a place in mainstream financial services for blockchain technology? Yes or no?
Qualified yes.
Okay.
Definitely yes. It's already happened. So.
Yes.
Yeah.
Consensus, yes.
So we have a consensus up on stage that it is pipeline, not pipe dream. Then be interesting. I'm sure we have some naysayers in the audience, but I'm sure they will make their voices known. So let's get into that a little bit deeper. So what type of blockchain technology are we talking about here? I mean, we just say blockchain, and that means a million different things to a million different people. So let's get into the specifics a little bit. Like, what do you mean when you say qualified?
Yes, that's exactly what was behind the question. So when we started actively looking at this technology within the context of cryptocurrencies, probably 2015, ancient history now in blockchain land, we worked out pretty quickly that in its native form, it won't actually work in financial services. That's a lot to do with all the effort that goes on with public cryptocurrencies to motivate anonymous people to behave well. And actually in financial services, nobody is anonymous because we're regulated. And so we've seen this evolution of the technology. Innovation never runs in a straight line. Back in 2016, I think many of us were using this term distributed ledger technology to differentiate from blockchain. We did that for about 18 months and then gave up because blockchain is just such a cool brand. But the qualified is that it's an evolution of the technology which will have the impact.
Okay, so it's not what was first understood to be the public blockchain on which Bitcoin was built. And I think everybody here would probably agree with that?
Yeah.
You can say no.
I would say that the sort of area where you see real disruption in the mainstream was last year, was the token offering model, which was rolled out of public Ethereum blockchain smart contract called ERC20. And last year, for early stage startup capital, the token offering model exceeded venture capital investment. So you already have a disruption. The question is the whole idea of anonymous-based crowdfunding is problematic for a regulated world, but it's still there, still be considered. And BlockPass is very much about bringing a regulated world, or bringing blockchain into a regulated world, because we're a reg tech for identity verification, so very useful for token offerings.
It's interesting, though, you're talking about disruption. I think you can move a lot faster in a non-regulated environment. You can do what you want, and you can live in that sort of fail fast, move fast and fail quickly type environment, whereas a regulated financial institution and the marketplace can't.
Right.
So it's going to be slower moving in that environment. But there are, even in the sort of less exciting sounding areas where you're looking at using the technology to make the post-trade world more efficient, that actually does have an element of disruption about it, because if it effectively takes out some of the functions that are currently provided, and the fact that we've got quite a granular setup of financial services at the moment, roles will shift, profit pools will shift, and the way people interact with each other will move. So there will be potentially disruption. It just won't be the sort of disruption you're talking about with the move fast and launch an ICO.
Yeah, well, it's still, I mean, most ICOs now are very following a regulated model. So they're doing sort of whitelisting all their investors. So they've already moved from anonymous base to identity verification. So we're seeing that already happen. And also another area where there's huge growth, massive growth, is trade finance and supply chain. There's enormous amounts of investments by companies like IBM in actually creating a platform for supply chain from end to end, A to B, tracking containers, tracking provenance of goods. So there's huge potential. I mean, IBM and Maersk formed a company that's based in the US that's just working on this project, on that whole concept.
I mean, sorry, were you going to speak, Marcus? Try not to fall off my chair forwards. Did you, I mean, so if, you know, to sort of pick up on that a little bit, if you're talking about, you know, IBM being a solution provider, but on the other hand, I know, Pete, you're working on building some things in-house as well. Do you want to give us a little bit of insight into where you've actually started implementing? So, I mean, you guys are not on the stage because you're thinking about it.
Just to chip in on the big picture, I think to my mind, the reason why it's so difficult to really figure out whether the collection you call blockchain is working or not is because its very nature goes deep. Okay, so most of the fintech work we deal with is on the surface. It's, you know, it's new apps and new ways that people can interact with technology. They're quite quick things to do and either fail or succeed with. When you start to rethink how the plumbing works, it's a big lift. And because of that, I think the impact will be much greater. And gauging when things are delivered and complete or not is actually much harder. I think you look back in time the same way that, you know, no one can actually pinpoint when the internet happened. It kind of happened between 97 and 2000, you know, whatever. Yeah. I think a similar thing will happen around the blockchain set of technology.
It's a really good point, because it's a bit like the internet. This stuff is only going to be impactful with adoption.
Right.
So people launching a point solution for something between 2 or 3 parties isn't going to be the big impact.
Right.
It's only when it gets mass adoption across markets, whatever those markets turn out to be, will you actually see the real impact come in. So that takes time. Adoption takes time. Yeah. And then you get a tipping point where things move very fast.
So just to go into that a little bit more, just to narrow that point down, we've had a question come in from the audience, which is how does an enterprise blockchain technology company scale? But at the same time, how, you know, each of you approaching this scaling point, which is what you're talking about, and those networks in a different way, how do you make sure that your solution is useful? Because if it's not a network, it's not useful. So how do you ensure, each of you, that happens?
I mean, we should be clear that what's being built here at the moment is infrastructure for the industry, and infrastructure takes a little time. But I think what you see is that back 2015-16, VCs were pumping money into this space. There was a lot of feeling a lot of these little startups were going to disrupt. What's actually happened, which is to be expected, is there's been a consolidation around maybe half a dozen very well-funded organizations that are working on infrastructure. We have one here in the payment space. And that infrastructure needs to be built before then people can play on top of it, right? And that's, again, then where the opportunity comes for building distributed applications on top of that infrastructure. And the speed you can build that infrastructure changes depending on which area of financial services you're looking at. So we look at the technology and we can see on a timeline which areas may drop first and which are the longer propositions.
Yeah. I think the comparison to the internet and mobile internet is very good comparison, because those technologies had early stages. Internet was before there were Windows, and mobile internet when it was wireless access protocol, which was very hard to use. I think the most important thing is scalability. These blockchains are not mature yet. They're not mature technology. Blockchain technology is not mature yet. So it's not scalable, but it will get there. It'll get scalable, and the transaction speed will be intensified. So there will be more blockchains. The question is, what blockchain will be the winner? The other issue, major issue for blockchain, has been user experience. UX has been terrible. So for the average user, it's been very hard to go and buy cryptocurrency and to use wallets and to use exchanges. So I think when the user experience gets to a point where it's attractive from a mass adoption point of view, I think, so it's not just infrastructure, it's also the front end. It's very important.
Just to kind of unpick that a little bit, so I want to pick up on your point about DLT and blockchain being a convenient name for something that's actually quite big. And what's been happening in the past couple of years is that firms and innovators have been unpicking the blockchain stack and applying workable components to make something happen. So in our world, we focused on the cryptography, and we recreated an internet model, and we recreated an IP protocol, which we call ILP. And then we used that technique to create a network which is infinitely scalable, like the internet, which is kind of counterintuitive coming from a blockchain company, but it's infinitely scalable. And that's having a really big effect. But in doing so, we had to kind of mature from the lab and from the ideological side, and then get our hands dirty, get practical, learn lessons, fine-tune, and not be too precious about what elements of blockchain you're applying. What counts is the impact that you're having. I think that's the trick. That's how you progress.
And presumably, talking about progression, it kind of leads on to the idea of what's the biggest hurdle. How do you decide which bit to unpick and go for first? Is it, oh, we need a business model and we have to prove that this is going to make some money, or do we have to prove that this is going to save some money, or is this going to keep the regulators off our back? Like, how do you decide which bit to go for first? Because as you've all just said, you have to do it case by case. You can't just go, we've done the blockchain and everyone's happy.
I think the key thing is to look at the business cases and look at how disruption is impacting those business cases and where they're going. But in terms of ordering, it was interesting because some of us back early on were latching onto this technology in terms of back office of financial markets, clearing, settlement, etc. Actually, that's the longest journey, and it's the longest journey because of the complexity of the infrastructure of financial markets. So where we're focused, and we've still got resource committed in terms of that long-term impact, because that will probably be the biggest one. But in the shorter term, we're replacing complex infrastructures called email and fax machines. And we're replacing them in supply chains. And it's basically replacing paperwork in supply chains. We're not talking about the finance. And so we're looking at things on different timelines, and those pieces that have the less amount of legacy infrastructure are the most practical to tackle first, recognizing that often technology isn't the biggest hurdle. It's often things like legal, keeping consortia together, etc.
So it's almost a similar pattern to what you've maybe seen to the option of cloud technology. Let's start with something easy and work backwards.
Yeah, it's funny because I guess it's the hard thing. We worked with working with about 120 banks around the world, and we've gone for the infrastructure day one, and that's really brought us a very long way. The prize is, you get this right, you change everything. It's just transformational, but it's a heavy lift to get there. So we're in a good place, but it's been a hard journey. The interesting point is the real kind of carrot to really make our customers want to do this with Ripple is the impact they have on their customers. So when we try to describe the impact to the internal organization, it doesn't really fire people up, because you're looking at how you can manage your costs, manage your internals. It's not the same thing as saying to a CEO they can transform how they go to market, they can change how they appeal to their customers, they can do many, many things they couldn't do beforehand. So I think it's concentrating on the end customer, the end experience that really fires people up. And if customers and your banks can look at this in terms of the vision, the prize in this journey, there's much more energy than just looking in terms of a spreadsheet or an ROI and getting into some very low scale stuff. So it's worth aiming high.
So, well, for us, the blockchain has been very useful, and it's allowed us to create an application which permits a registry or a whitelist of verified users, so that users don't have to continuously go through KYC process, know your customer, anti-money laundering. So the blockchain is ideal as because of its immutable nature, the fact that the records on the blockchain are permanent. It's ideal as a registry. It can be used as a registry for verified users. It could be used as a registry for ships, the ship registry. It could be very suitable to bring banking to the unbanked parts of the world. So people in developing countries can have identities that they control, identity data that they control, not centralized authorities or big companies like Facebook or Google. So that's what BlockPass is about. It's about giving identity to users, giving identity control, and allowing them to use financial services in a way and method where their data is protected. So.
Pete, did you want to add something?
Yeah, I was just going to say, I think one of the key things here is for this stuff to be really impactful, we need to be able to get both our assets, be they cash or financial assets, and identity onto these systems. And all the amounts that are playing with different sort of use cases is going to be difficult to get any actual credible value out of it, and if you haven't got the equivalent of real-world cash on these things and being able to manage identities on these things. So I think that's where our focus has been. We're still, even though blockchain itself, or the collection of technologies that is often known as blockchain, is still evolving, so is that layer on top, the financial layer on top and the human layer on top, or is it, whether it's identity of humans, whether it's identity of companies, whether it's identity in the machine economy of things, then until we've got those things embedded into these networks won't actually have their real value of providing new services on top.
That kind of leads into a question we have from the audience as well. Somebody said, why couldn't any of this just been done 15 years ago, just using a shared database architecture? Is it because the technology didn't exist? Or is it because organizations didn't have the appetite to collaborate or infrastructure? Or is it, as you're saying, that the idea wasn't there, the vision wasn't there?
Maybe I can give a perspective.
I think everybody wants this one, so we'll go down the line.
Okay, so I'll give a perspective from living in the front office of financial markets for the last 25 years, right? And actually, financial markets went through the first digital transformation of any industry in its front offices back in the late 80s. And in that environment, it was a highly competitive environment. So the commercial incentives weren't there for the level of collaboration you need to have this standardization and these elements that would make those markets really frictionless. And I think to the points that were being made, it's simple things now that we're trying to unpick with this technology, such as none of the banks have the same reference data. They have different reference data for different products. And it's this kind of boring stuff, which when you look inside is like spaghetti. And so we're living with that legacy, and it was the environment that we had, say, 15 years ago, that meant that we didn't necessarily build stuff in the most efficient way.
Almost attitudes there, sort of from your perspective then, it's kind of the commercial, there wasn't a
the commercial incentive.
Yeah.
My answer to the shared database question is the Bitcoin blockchain has never been down in 100% uptime in 9 years. It also has never been hacked, the blockchain itself. So you say that about a database, a shared database. I think it'd be much easier to hack, much easier to end up, it won't have 100% uptime because it's taken down often for repairs and updating databases. So that's my answer, is that actually a public permissionless blockchain has more security. The bigger it is, actually, the more secure it is.
So your perspective is technology. Your perspective is commercial. Marcus.
Well, I'm going to go for the humans in the room. So I think it's funny how really blockchain could have happened in 1972 or maybe 68. So whenever you have computing, basic database technology, it could have happened. I think the science of why invention can often take a long time before the spark hits and everything lines up and things happen. It's a deep one. I think a lot of it's about society actually taking a long time to adapt to a new way of doing things. So computing arguably has been used in the past 40 years to automate what was there beforehand. Trade finance is a great example of this. There's tons of computing power goes into reproducing what some people worked out in like 1880 based on a method figured out in 1500. Never changed, it's purely automated. It takes time and maybe a little spark before people say, actually, this is a new paradigm now. I can do things fundamentally different than what I used to do beforehand. And that's what's happening now. There's no real magic formula, there's no time formula. It just needs the ability, the opening to be there, and then the spark then.
But coming back to the commercial incentives, right? Actually, in the trade finance use case, for example, taking trade finance electronic is infinitely easier than taking capital markets electronic, and we did that. There is, in complex supply chains, there are a lot of stakeholders, a lot of different interests, a lot of maybe competing interests. People in one part of the supply chain don't want other people in the supply chain to see their transactions, and so this technology is overcoming that trust issue. Now, it may have taken quite a while for that to be worked out, but there is generally a commercial incentive behind some of these things that drive them to fruition.
So look, as somebody who's spent most of his career in the post-trade world in financial services, looking at systems, that's very much, there's a lot of the post-trade financial market infrastructure is about shared databases already. And not distributed ledgers, but shared databases. As we have electronified financial services over the last 50, 60, whatever number of years it is, there's been more and more centralization and reliance on central parties. I think what this technology is bringing is sort of saying, look, we've eked out as much efficiency as we can in that sort of model, and we've spent probably in the previous decades, most of our attention on innovation in the front office of financial services. So now it's, can we actually look at a new paradigm of decentralizing things, either radically, as in the cryptocurrency space, but maybe less radically in the regulated financial market space, but actually does that bring us a new set of opportunities, a new set of toolkits for being able to manage the assets, where we can actually have assets on the network that are unique, which previously we had a load of processes around it to try and make that work, which actually became complex, risky, they became slow, locks up a lot of capital. Are there ways of doing this more efficiently with the sort of shared nature of distributed ledgers? You know, one of the things most financial institutions spend most money on right now is the concept of regulatory reporting. You know, if you could get assets in a shared network that the regulator would be able to see in a permissioned way, you could effectively take a lot of that cost and mistakes out of the system and enable sort of a more proactive regulation going on. So I think it's just flipping it around and moving away from a model we've probably eked all of the efficiencies out we can and trying to look for a new way of making markets more efficient.
But if you were to look at, we talk about blockchain, and I was listening to the ICO session earlier, I think Dave Birch there. It's about tokenization, right?
Yeah.
And the impact that can have in our industry and others, actually. And you peel it back, it's that's the change that's really happening.
So we've got like 2.5 minutes left. I'm going to ask you the question that they all want an answer to, particularly from the two banks. How long are we talking? So, you know, before we actually see, you know, financial institutions using blockchain technology to do processes, not running alongside, not POCs, like actually doing things, whether that's email or whether that's, you know, tokenized identity. Give us a number, everybody.
So it depends on the use cases, right?
It depends,
but,
damn it.
no, to be more specific, you know, our immediate focus from a commercial point of view is removing paper in supply chains and trade finance processes that interact with that supply chain. Year and a half ago, we were doing the production trades, right? But these are, you know, curated. They sit alongside the existing production world. We've had press releases. We're part of We Trade Consortia, that's the SME trade finance platform, Easy Trading Connect in the trade finance world, and there will be others that I can't talk about so much. I think the key when you say production, and somebody was saying this to me earlier, definition of production is really if you turn the system off and you're in real trouble, that's production, right? And you know, we're going to see these the consortia we're engaged in go into production this year. When we'll be in real trouble if we turn it off, starting in 2019 onwards. And then other use cases are a lot further out. The thing we started working on in capital markets could be a decade or more away before it has a material impact on the industry.
Interesting.
I think in 5 years, you know, we're going to see real mainstream adoption. I mean, it's already occurring. I mean, every year we have a trade finance and supply chain event in Hong Kong that we host. And I mean, we're like 4 times as many people turning up, 4 times as many enterprises, shipping companies, container companies, you name it. They're turning up. They see what Maersk is doing, and they're serious about it. I think provenance, supply chain, and trade finance is a huge area. So I think that's really important. I think what's key, though, is the maturity of the technology. And two things are really important in that technology. That's the consensus protocol, because consensus protocols, like in Bitcoin, it's called proof of work. Now, it's very inefficient protocol. The more efficient that the protocols are getting, like you see in NEO or EOS blockchain or in Ripple, where you have scalability is better, much better, then you will have more adoption. Also, smart contract technology is absolutely key to trade finance, because you can take a smart contract and replace trade documentation with smart contract technology quite easily. So it's just a question of the industry adopting it.
Okay.
So.
Now, it's here. Yeah, our banks processed our first $1 billion this month, and since we launched, and we'll quickly do our second and third and fourth, and the network's building. Every day, people transact over Ripple, 2 seconds from Japan to Thailand, I don't know, Sweden to the USA. So the message I have is, careful with this stuff, because it's real. This is not out there 5 years on. It's happening, and like frogs being boiled in water, if you're not careful, it's too late to jump. The world's moved.
Yeah, I think I'm terrible at making predictions with hard numbers and time. I would say, yeah, I mean, there's a terrible cliche that it's going to happen slower but be more impactful. But I actually think there are cases where it's starting to be real right now. I still do think there's an awful long way to go. And the fact that you have to bring multiple parties on the journey with you, and it's about adoption, does make it slower than developing other emerging technologies, which you can do in a locked room in a lab and do in private. So that will slow it down. But I'm still, part of me is quite cynical and skeptical. On the other side of things, I do think there's a real opportunity here. I don't think the genie is going to go back in the bottle. I think the solutions might not look like what we're imagining them right now, but I think in the long term, this will create a way of plumbing financial markets together in a different way.
So the message is it's coming. It's coming sooner than some people think, and you need to be ready. Brilliant. Well, thank you so much for joining me, gentlemen. Thank you very much for our audience. We had loads of questions. I'm sorry I didn't get through them all. And thank you to my panel.
All right, thank you.